So my name's Ed McDermott. I'm CEO of Seed Innovations. Essentially, we are a listed venture capital firm. This means that ultimately, although we're a closed-ended fund based out of Guernsey, regulated in Guernsey, we're also listed on London Stock Exchange AIM, which allows anybody to buy shares. So if you like the company, you can buy it in the morning, and if you don't like the company by the afternoon, you can sell it then. So ultimately, we're trying to open up the landscape for VC investors to not just be the wealthiest 1% of the world and make it accessible to anybody with any means. So if we move through very, very quickly, I'll give you a brief introduction, and then as Alex said, we're going to sit down and actually discuss the company because you guys have been pitched at all day, and I think it's actually quite nice to hear a bit more of a natural approach to what the business does and why it's interesting and why we believe that it should be in your small cap portfolio. But as I mentioned, we're AIM quoted. Our ticker is SEED, S-E-E-D. So very nice and simple. And it essentially says what it does on the tin. And by that, it means that we are ultimately investing in companies typically at early stage, so pre-Series A, sometimes at the founder level. And we actively manage our portfolio. So we don't just passively invest, we get very involved in the companies that we are invested in. At the moment, I'll skip through a couple of slides very quickly. This is the board, very experienced board, PE, VC, financial services, financial strategy backgrounds, lots of governance across the fund, which is a de facto piece of being an open-ended fund in Guernsey. Our investment process has to be a little bit different because ultimately we're investing in companies often at an early stage. That means there isn't a great long history of data and a number of factual points that we can go against. We really have to understand the management of the companies that we're investing in. Now, of course, we do all the typical due diligence that we possibly can, but we really have to have a good feel for whether the people that we're investing in really know their industry, and more importantly, whether we know that we can help them in their growth journey. So we're not just capital, we actively get involved. And with that, I'm going to sit down with Alex and we're going to have a chat.
Yeah, thank you, Ed. So you're coming at this with experience, not just as an investor, but also in founding and achieving a commercial exit in a life sciences company.
Absolutely. We've had a number of successful exits which have led to real cash coming back into the fund. Ultimately, the goal of any fund is to grow the net asset value. But of course, net asset value is one thing. That's a number on a screen. What really matters is what can you bring back into the company? How can you actually seek a proper exit of, and there's actually a few case studies in the slides where we're talking about some of the exits that we've had. These are real cash exits, not just NAV on a screen, which is critical. Ultimately, we have to be able to demonstrate that we can take a company through its foundation. And in our case, as I said, it was often pre-Series A investment all the way through to getting liquidity back into the fund so that either we can pay dividends to our shareholders. We did our maiden dividend last year, which was, at the time, we were trading around 2p, and we paid a 1p dividend, so a 50% dividend, which is pretty unusual for an AIM company.
Yeah, so we were having a conversation before, and you were saying at events like this and just in general, you spend a lot of time getting pitched to as a provider of funding. Given your experience, what are the three things that you're looking for that form your main assessment criteria when you're looking at something new?
For us, there are certain industries that we are not going to be able to add much value to. And in those cases, it might well be a brilliant opportunity. But if it's something that we don't understand, it would be irresponsible and reckless of us to invest in that. So typically, we look for something that we have an understanding of, that we know we can add value to. It has to have a management that is capable. If it has the makings of a good management, but we feel they're lacking in finance, we will actually, and we still really like the company, we will go in and try and find them the right finance functions so that we can make the investment and feel comfortable and have that relationship with the company that we can talk properly about their treasury management, for example. You mentioned lots of companies raising money. Part of that, in many cases, is because people have raised money at much higher valuations in better times where the pools of capital were somewhat more freely flowing, and they haven't managed their treasury that well. Or they've just assumed that they're going to be able to raise money and conditions won't change. You can never assume that as a founder or an entrepreneur in any market.
So before this, you challenged me to ask you difficult questions, and so I hope you don't mind. I'm going to ask you a tough question. So an investor listening to you speak now might say, well, it's fantastic, you've got a brilliant team, fantastic strategy, proven track record of success. But if you look at the financials of the company at the moment and its market stats, you're trading at below cash value, and so you've got more cash in the bank than you do market cap. That's not factoring in the value of portfolio, within which there are many fantastic companies. And so an investor might say, well, if the market hasn't been able to recognize the value of the cash you have now, let alone the investments, what about in 12 months' time? So if I invest now, what confidence can I have that the market will start to recognize it and I'll make money?
That's a really brilliant question, and it's a problem we've suffered in this very illiquid market where pools of capital have been leaving small caps. Understandably, many small caps have been raising money at ever-growing discounts in order to essentially keep the lights on. That's not a problem we've had to face, but it's something that has affected us. Now, I'm not blaming other companies for our, let's be honest, poor share price performance, but ultimately, it is difficult running a fund. When you run an operational business and you have operations here or a single business that you operate, it's very easy to consistently tell the narrative. What investors don't always know when they come and invest in a company like Seed is, well, that's all good and well. You've invested in some things that look interesting, but how long are you going to be in them? And typically, most venture funds, you're looking at a 7 to 10 year lock-in, and that's why we still believe in being listed, because it gives you, the shareholder, the opportunity to buy and sell at your content. You can say, I really like this business. Once it's sold, I don't want to be invested in Seed anymore. The big discount, as I said, it's multi-factor. What I think we need, and what I've always tried to say to investors is, look, we aren't stupid. If the share price doesn't materially improve during the course of this year, and our assets are worth, we've got 90%, just over 90% of our net asset value is £3.5 million of cash and over 6 million in three companies. Three companies, one of which is here today, Clean Food Group, which also agronomics are invested in, Juvenescence, which many of you might be familiar with if you follow Jim, and another company called Avextra, based out of Germany. Now, these companies, every year for the last 3 years, have raised money at higher valuations in very difficult times. So, again, we like to think that we're demonstrating that what we've invested in is solid, but I also understand why investors would be nervous about the markets in general, because it's very difficult to move a share price. But one thing I will say is, when our share price does move, it tends to move quite quickly.
Makes sense. Second hard question. Related party transactions. So an investor might look at the number of related party transactions that you've announced and say, well, perhaps this is a cause for concern. How should a potential investor interpret that, do you think? And maybe just for context, if you want to explain what some of, that might have the context I'm coming from here, what some of them are.
A number of them are actually right here on this slide, so it's a perfect slide to have up for this question, and thank you, Alex, again. Brilliant question. Some investors, understandably, are nervous about related party transaction, and that means companies, for example, Jim is a over 13% shareholder of Seed Innovations. He's also a big investor in agronomics. We are both invested in Clean Food Group. As individuals, we were all invested in EMAC Life Sciences. We were also all invested in Nuvera. These are companies that we essentially were part of the founding group, and therefore we know these companies extremely well, and we control, to some degree, or to a large degree, the direction of those companies, which means we have the most confidence in the things that we can control the most. And when we build these companies, we're building them towards an exit. Whereas sometimes when you invest in a company that isn't of your making, you don't necessarily have any real control on when the exit is. And whenever you make an investment, as any investor, you should always be thinking before you make that investment, how am I going to exit? What are the catalysts that will lead to that? And we believe through these related party transactions, actually, we have ultimately we can demonstrate we have generated the best possible cash returns. That's not to say that some of our other assets haven't increased massively in terms of net asset value, but as I mentioned, that is essentially a number on a piece of paper and it's not real until you can sell it. We're very, very thorough when it comes to our net asset value statements, I should add. We do that, they're independently audited. It's not just us saying, we think it's worth this. And we're very conservative about it. And if you look at recent partial exits, such as Avextra up here, that was just above the net asset value that we held it at. So again, proof that, or somewhat proof that what we're claiming actually has some basis in reality.
So that's all to say that the proximity and collaboration should be seen as a sort of force multiplier to help get a proper cash return rather than something else.
You've actually put it far more eloquently than me, Alex, so I appreciate that. He's showing me up already. But no, that's absolutely right. Ultimately, the closer you are to something, the more you can control it, the more you can shape it, and the more you really know the management and while you may not be involved in the actual day-to-day operations, you're about as close as you can be to that without essentially running the company.
Okay. A little bit of a subject change, but I noticed looking through your most recent announcements that part of your investment strategy is also short-term trading or short-term investing. I didn't look into it much further than that, but do you want to explain what you're doing there and how that fits into the picture?
Absolutely. So we have our typical long-term venture strategy. And when I say long-term, we're not talking 7 to 10 years. Our goal is always a sort of 2-year turnaround. So 2 years from investment to some form of liquidity. It doesn't always work like that. Market forces, flavor of the month, trends change. But we always invest in things that we believe either in the short term, medium term, or long term, there will be some opportunity to see liquidity. But one thing that we have got a lot of experience in is small cap. And therefore, we see all the placings that go through the City of London, particularly around small cap companies. And for us, it's fairly simple. When we know that we're looking at a business that has really good traded volume, that has upcoming catalysts, it makes sense to use a smaller portion of our NAV to try and drive short-term returns. And to give you an example of that, we've had a number of companies where we've made up to sort of 300% returns in as short as a week of holding. This isn't typically on massive quantities of cash. It might be £100,000, it might be £250,000, but still material returns in short term is what that particular strategy looks like. But the bulk of our strategy is very much geared towards the sort of VC, PE type private enterprises. And the short-term strategy is all geared towards listed companies.
Yeah, so I suppose another way to look at that is you're an investor by trade, you're making long-term bets frequently, but in the meantime, why not make use of that expertise and figure out another way to monetize it?
This guy's very good. I'm not going to lie. He is nailing it.
I've asked a lot of questions.
But yes, he's totally on.
And I've got plenty more, but before I do, are there any questions from the audience? Yes, we've got one here.
I looked at some of your information, and one thing that stood out to me was an operating charge of 7%, which struck me as being ambitious. I wonder if you could comment on your thoughts on that and whether your shares might be more attractive if that was trimmed to something more in line with what one might describe reality.
That's a really, really good question. And what that actually relates to is something around our key information document every year. We have to produce that. It's actually really not fit for purpose because it's really geared towards big REITs and much larger funds than we are. And what it's essentially trying to do is create this incredible perception of unbelievable risk. And that's just because it's very unusual to have a proper fund structure that's listed on AIM. So our real costs as NAV we reduced them by 9% in the last quarter of last year, and our real costs are too high, to be quite honest, but they were about 4.5%, not 7%. It's the way that it's been read by the financial institutions that are reading something. I'm not explaining it very well, probably, but ultimately it's something that's not really well placed for something like seed.
How many people do you employ?
So in terms of employment, we have the board, which is 5. Then we have a company that we use to do our administrative work in Guernsey. And then beyond that, we only have a couple of people who are consultants.
Thank you.
Thank you.
Any more questions for Ed? Yes, one over here.
The burn rate on a monthly basis is somewhere, depending on what we have going on transactionally, it sort of bottoms out about 50,000 and goes up to about 70,000 at the peak. But as I said, typically in a good year when we grow our net asset value, there's no tax on that net asset value. So when we have had our big wins, all of this is essentially comes back to the investor either in the form of share buybacks, which we also conducted last year, dividends, which we did for the first time last year. So yeah, we're trying to drive costs down, but the best way that we can drive costs down is not increase our costs, keep decreasing them, but organically grow our net asset value. I think this year you're going to see, again, I can't make promises or statements that are leading, but I think this year we're going to see some material gains in a couple of our larger assets, which are also very exciting.
Got to get the disclaimer slide back up before you say that.
The disclaimer slide, yeah, exactly. This is not financial advice, and I am not a financial advisor, but you know, we're very, very positive about 2025. We have assets that are bucking the trend, shall we say, of some of the negative things that we're seeing perhaps in government and in policy making, items like Clean Food Group, which fit right into the sweet spot of where they are spending money, where they are pushing the boundaries, shall we say. But yeah, we're very fortunate in terms of having a nice cash position. We don't need to go anywhere near raising money. Our sole interest is in growing organically at this point. And you know, when we hope share price catches up with NAV at that point, we then maybe look to increase cash.